Okay, welcome back. Almost done in here, so let's wrap up other inventory issues. So we're going to talk about other inventory valuation issues in this segment. So what I want you to think about real quick, what we've talked about, everything we've talked about so far, inventory costing, it's assumed that we take a bunch of individual items and we use all those, we combine them all to construct one product, right? We talked about whatever, constructing chairs, or at least it was the same product. We bought beans and spinach and we sold beans and spinach. It was always at least a 1-for-1 or like many to one ratio. And we talked about how we combine all these items. Now, that's one way to do it. Now, what do we do if we have one input and lots of outputs? How do we cost inventory when we take one component and get many products? Okay, this is a little bit more difficult to conceptualize, but it happens all the time. This is not surprising. It should not be overly surprising for you in general. If we just look around at the companies, the major companies in this area, we have like one of the largest, essentially, meat producers, consumer and meat producing companies in the world in this area. Well, guess what? When you produce meat, you buy one input and you get lots of outputs. So when you produce, say, whatever, a steak, okay, when I go into the store, I buy, say, a ribeye. However, a ribeye is just one small piece of an entire cow. So the company is going to buy a cow, and then they are going to produce ribeyes and flank steaks and everything else that exceeds my understanding of the butcher process. They're going to get all the other things that they then sell to consumers in the store. So we have one input and a bunch of outputs. There's other examples of this. Real estate development is another. So you buy one large parcel of land, you divide up into lots of small pieces, and then you sell off the individual pieces, say to builders who want to build a house on them. So that's another, real estate's another example where we have one input and a bunch of outputs. Now, the question is, well, how do we do this? So there's a couple of different ways, because the question is, okay, well, we know what the value of the input is because we bought that input. What's the value of the output? Whether it's steak or land or, I don't know, oil and gas is the same way. You pump oil out of the ground, there's an extraction cost to that oil or raw oil. I buy, say, crude oil from wherever I want to buy crude oil. So I buy crude oil. Through the refining process, a barrel of crude oil turns into all kinds of different things. Everything from unleaded and diesel to kerosene to tar, all the products associated with one thing of oil, one input, lots of outputs. So there's a couple of ways that GAP has essentially agreed to or accepts providing a value to that ending piece of inventory. The first one, under some conditions, you can actually use the market value of that good to determine what it's worth. Now, this is only allowed in a few circumstances, and there have to be a couple criteria. Three of them, there's three things to think about. It takes two of them to be allowed to do this. First of all, always, there has to be a controlled market with a quoted price applicable to all quantities. For instance, in oil, once I have the oil and I use it to produce, say, unleaded and diesel and kerosene, well, there is a controlled market with a quoted market price applicable to all quantities. At that point in time, I can sell my unleaded gasoline into a market anytime I want. It has a quoted value that I can use. Well, because of that quoted value, essentially, as soon as I produce the gas, I get to recognize essentially all of my revenue associated with producing that gas because there's a quoted market price for it. I don't have to figure out, well, what were my costs associated with getting this amount of unleaded gas, given that it may be more or less valuable than the diesel or the kerosene or the jet fuel that I'm producing from essentially the same barrel of oil. So there has to be a controlled market. This is the case for essentially a lot of like oil and gas products. There is a quoted market, a controlled market with it fits that category, and a lot of livestock. If you go on to, say, the Chicago Mercantile Exchange, you can buy whatever pork bellies, and there's a lot of farm products like essentially dent corn for all different types of whatever. You can buy and sell this stuff. It has quoted market values. So because of that, you get to record the market value for those goods. Now, there can also be no significant cost of disposal. Now, if, let's say, whatever, you have intermediate bent West Texas intermediate bent crude that has a quoted market value, but you want to sell it into a different market. Well, the cost of getting it to a different market actually makes it more difficult. So you have to use it based. That's why there's market values and different market values based on where is that fuel coming from. So West Texas intermediate crude is essentially housed almost entirely in Tulsa, I believe. So, for instance, no significant cost of disposal. So those two criteria, and it has to be too difficult to obtain cost figures. So that, like, either no significant cost of disposal or too difficult to obtain cost figures. So that is how it's done. So valuation for some of these items, if there is a controlled market with a quoted market price applicable to all quantities, then you can record the inventory value at market values. That's pretty critical. And it generally is constrained to essentially raw materials and things with quoted market prices. So I'll show you a quick example of how this ends up getting reported. So Mumford of Wyoming, this is actually a ranch. So they have essentially cows and sheep on the same ranch, which is ironic if you're from the West. Cows and sheep, farmer ranchers don't typically get along. Anyway, they have cows and sheep. And if you'll notice, the last item in their reports, dressed meat and byproducts, principally at market less allowances for distribution and selling expenses. They get to price those at the market value because there is an actively traded controlled market for those items that they can sell into right now if they wanted to. So that is how they value all their inventory. Now, if we want to move outside of the quoted essentially market values where we have some controlled market that gives us the value, and want to do, let's say, land. There is no controlled market for land, for instance. I can't just decide, I'm just going to sell my land today, and I know exactly how much I can sell it for because it's a controlled market for that. No, every piece of land is valued individually. Some land that could be right next door to other land could be worth substantially more or substantially less. Therefore, we don't have this market value option for the end goods. However, there's lots of cases where a developer comes in and buys a very large parcel and chops it up into a bunch of different pieces and then has all these individual pieces in its inventory. It needs to somehow measure the value of that inventory. So one thing accounting has done is we use what's called the relative sales value. The relative sales value is essentially taking what we think we can sell something at and then backing into what the cost is associated with that item. So in this case, we essentially are saying we are going to make some some fixed margin on everything we sell out of this development, for instance. So and that margin is determined by the total cost of the land and the total sales price of all the lots that we're selling. That gives us our margin. We apply that to every single parcel, and that's how we end up with our inventory values. So let's take an example. So we have a developer. They purchased land for $1 million that it's going to subdivide into 400 lots. They're different sizes and shapes and locations and all a bit different, but in general, they can be put into 3 general grades, A, B, and C. They sell, and as they sell lots, they proportion the purchase cost of 1 million among the lots sold and the lots remaining on hand. And here's how they do it. So our relative sales value example, we're going to take an example where we take this piece of land. We have our lots A, B, and C. We have the number of lots. There's 100 A lots, 100 B lots, and 200 C lots. The sales price per lot, $10,000, $6,000, and $4,500 for A, B, and C respectively, which gives us a total sales price of $1 million for the A lots, $600,000 for the B lots, and $900,000 for the C lots, which gives us a total sales price of the whole development of $2.5 million. Remember, we only bought it for $1 million, so we have like a 250% markup on this. Now, we want to figure out the relative sales value. So for our A lots, we're going to sell them for $1 million out of 250 or $2.5 million, which gives us, what do you say, 100 divided by 250 is our ratio. Multiply that times our total cost. Okay, so A lots are basically as a rate proportion, the value as a proportion of the total sales price is 100 over 250. So we multiply that times our total cost of 1 million, which gives us a total cost allocated to the A lots of $400,000. So we have 100 of them, divide 400,000 by 100, we get $4,000 per A lot. We do the exact same thing with the B lots. They're going to have a total sales price of 600 out of the 2.5 million. So we did 60 divided by 250. Multiply that times our cost of $1 million gives us a total cost allocated to the B lots of $240,000 or $2,400 per lot. We can do the same thing with a C. I'm not going to walk through it. And if you notice, our total cost allocated to lots equals $1 million, which it should. And we now know how much we're allocating per lot, our cost per lot. We did that based on the relative sales value. So we based on, okay, what will this lot sell for? Now let's assign the cost essentially proportional to what we can sell it for. Every single lot we sell, we are essentially going to make 250% on, minus all of our costs. But because it doesn't matter whether we're selling A lots, B lots, or C lots, we are going to make 250% on those. If you notice, we have a cost of, let's say, $4,000 for our A lots. We're going to sell them for 10. Well, guess what? 4,000 times 2.5 is $10,000. So every lot gets the same, essentially, the gross margin or the markup. It stays the same regardless of the lot. And that's how it ends up working out. So we are largely done kind of our special items. Moving on to some other issues we run into in inventory items. So one is purchase commitments. We have a problem. In general, when you sign a contract, there is no accounting transaction. We don't account for it in any way. We don't recognize the signing of a contract. However, if you sign a purchase commitment guaranteeing that you will be buying something in the future for a fixed price, well, at the day of signing, there's no accounting transaction there. However, if the value of that item decreases below what you've agreed to pay for it, that is going to have to be a loss and essentially a liability until you pay it. And that is because you need to recognize the loss in value of that when it actually occurs. You don't get the privilege of waiting until you actually execute the contract to recognize the loss. If the loss happened, say, a year or two ago when the market value dropped of that asset. So in this case, generally the seller retains title to merchandise because it's just a commitment, and the buyer recognizes no asset or liability at the time of the contract because there's no accounting transaction. If it's material, the company does need to disclose that. A lot of times there are no single material items, but companies routinely enter into purchase commitments, in which case they will usually have a footnote in their financial statements that say, in the normal course of business, we enter into purchase commitments. An evaluation of these purchase commitments at the end of the year revealed that none of them needed to be adjusted for loss in market values or something like that is normally what you would see. So now, if the contract price is greater than the market price, the buyer expects that losses will occur. So in this case, you agreed to buy something, let's say for $10. Now it's only worth $5. Okay, that means that the contract price exceeds the market price because theoretically the market dropped. So when the purchase is affected, the buyer should recognize losses in the period during which the declines in the market value take place. They don't get the privilege of delaying the loss until they execute or until they actually fulfill the contract. They recognize the loss as soon as the market value drops. So what does this look like? We have a paper company. They sign a timber cutting contract to be executed in 2018 at a price of $10 million. Now, let's assume that the market price of the timber cutting rights at the end of 17 has dropped to $7 million. There is a drop. The market value is now less than the purchase price or the purchase contract will be. What entry do they need to make? Well, at the time of the drop, they need to recognize a loss and a liability. So they said they have a loss, a debit of $3 million, and they have a liability they set up for $3 million. Now, at the time they actually fulfill that contract, what they will do is essentially the liability will be paid, and in this case, the $10 million will go out the door, and they'll end up with $7 million of inventory. Now, if there's going forward, they are allowed to recover some of these losses. If the prices go back up in the meantime, they can recover that loss up to the contract amount. They can't go over the contract amount because then it would be above cost. But this does not have to be a permanent reduction because they don't actually own the inventory yet. It's just essentially a financial asset, this contract is. So that's how that gets reported out. Now, let's say they are permitted to reduce their contract price by $1 million. So they work out with the seller. They're like, hey, we lost a bunch of value. Is there any way we could, whatever, we need to do this. So what they're going to end up doing, that $1 million, they get to relieve the liability. So their liability would go down by $1 million, and they'll get to recognize a gain that will offset the loss that they recognized probably in a previous period. So let's say, I think it was then end of 17, they recognized that loss. Let's say sometime in 18, they work out this deal with the seller to only pay $9 million instead of $10 million. They then get to reduce the liability from $3 million to $2 million and recognize a holding gain of $1 million, which would be a credit to unrealized holding gain or loss. So they get to flip that around. So that is how we account for purchase commitments. The key here is that the losses associated with the valuation changes of purchase commitments have to get recognized when it has lost value. You don't wait until you buy the inventory and immediately recognize the loss if you knew the loss occurred in a previous period. So there's a couple other methods I want to go over about determining ending inventory values, or essentially measuring ending inventory. Now, all of these are essentially kind of substitute measures to approximate inventory. These are not really acceptable methods to report year-end inventory amounts on your audited financial statements. Now, there are some exceptions here. Let's say your warehouse burns down at the beginning of the year. You have no inventory to count, and therefore you don't know how much inventory was actually there. Well, you can use this method to approximate your ending inventory, for instance, in that case. But that is a very rare example. Normally, these methods are used to approximate inventory under the idea. So we're going to start with the gross profit method. Under the gross profit method, this is a substitute measure for approximate inventory. We begin with inventory plus purchases equals total goods to be accounted for. Pretty straightforward. This should go right back to our periodic inventory calculation. Beginning inventory plus purchases gives us goods to be accounted for. Now, goods not sold must be on hand. That's pretty straightforward. Now, the sales reduced to cost deducted from the sum of the opening inventory plus purchases equals ending inventory. That's a really fancy way of saying, well, if we typically sell inventory and our gross, the cost is, let's say, 80% of the sales price. Well, if we know our sales, we can just take 80% and we know that's our cost of goods sold, at least an approximate estimate of our cost of goods sold. So that once we know our cost of goods sold, we can then figure out what our ending inventory is, basically like flipping the equation that we had before where we take goods available for sale minus ending inventory gives us cost of goods sold. We're not going to flip that. We're going to say goods available for sale minus cost of goods sold gives us ending inventory, and we're going to estimate cost of goods sold using previous historical or anticipated gross profit margins and just apply it to sales, which will give us an approximate cost of goods sold, which will give us an approximate inventory or ending inventory value. So let's take an example. We have Cletus Corp. At the beginning, has a beginning inventory of 60,000, purchases of 200,000. So goods available for sale of $260,000. The gross profit on the selling price is 30%. Okay, that's the gross profit, which means that the inventory is, let's see, if the gross profit's 30%, inventory is 70. Cost of goods sold is 70. So here's how they're going to apply this. We know, so beginning of 60 plus 200 gives us goods available for sale of $260,000. We had sales of $280,000 and we know our gross profit is 30%. So our gross profit is going to be 30% of 280, which is $84,000. So therefore our sales at cost, or the cost of goods sold, are going to be $196,000. If we take that out of our goods available for sale, we get an approximate ending inventory at cost of $64,000. So that is how we use the gross profit method. We use essentially our gross margin or our gross profit percentage to estimate our cost of goods sold for the period. Once we do that, we can just get to ending inventory using a similar version of the equation we did before, where we take goods available for sale. This time we subtract out cost of goods sold to get to ending inventory. Instead of typically we count our inventory, we subtract out ending inventory to get to cost of goods sold. This just flips that and gives us an estimate of our ending inventory amount. Now, something to keep in mind. Now, this applies in this case, this applies a lot of times in terms of how do ratios work. And I've mentioned this or alluded to this as we've run into it periodically, where, well, if it goes up by 100%, it would then be reduced by 50% to get back to the same point. That's somewhat straightforward. So the question when we're dealing with this, if we know, say, the gross profit percentage, which is what we just dealt with, of 30%, we know cost of goods sold percentage is then 70%. So that is going to basically be a percentage of the retail value. Well, we might not know the percentage of the sales value. We might instead know what the markup is. Let's say we mark up all our inventory by 33.33% or a third. So, well, then what do we need to reduce sales by to get to estimated cost of goods sold? How this is done. So we'll take an example here, quick illustration. This becomes largely right out of the Wiley textbook, but to compute gross profit percentage, we assume that we have an article that costs $15 and sells for $20. So the markup is $5. So our gross profit is $5. Now, our markup as a percentage of retail is 25%. 5 over 20 is 25%. 5 is a quarter of 20. That's our markup over retail. So it's 25% at retail. Now, the markup itself is 15%. We're taking cost of 15 and going up $5. That's 33% or 33.33% markup. So it's kind of like, well, how do we convert between the two? So first of all, gross profit on selling price is going to be the percentage markup on cost divided by 100% plus the percentage markup on cost. So the percent markup on cost divided by basically 1 plus the percent markup on cost, and a percentage markup on cost. So that was the first one was gross profit on selling price. The percent markup on cost is going to be the gross profit on the selling price over 1 minus the gross profit on the selling price. So that is the equation. You should be familiar with how this stuff kind of works and be able to go back and forth both ways. So take some time, look through this. I'm not going to go through a whole lot more examples because this is largely just how did you work the math, and it's just need to know how to do it. A lot of times it helps if you just think it through in terms of the 5, 15, 20 example that we kind of just went through. And you can largely kind of back into it. So in that case, if you're given, say, the 20%, which is the gross profit on the selling price, and you want to get to the percent markup on cost, you take the 20% over 1 minus 20% gives you 2 over, or so 20% over 80%, which is 25%. And if you're given, say, 25%, and you need to calculate that, you're going to take 25% over 1 minus 25%, which is 25% over 75%, which is 1/3. So that's largely how that kind of computes back and forth. So anyway, be familiar with kind of how ratios work and relate to each other in this regard particularly, but this is something that you need to kind of be aware of when you're working forward in your accounting or finance discipline regardless. Okay. So if we get back to our gross profit method, we have the company uses gross profit method to estimate inventory for monthly reporting purposes. Now we have this information for the month of May. So this gives us our inventory, our purchases, freight, sales, sales returns, purchase discounts, et cetera, et cetera. Now let's compute this assuming gross profit is 25% of cost and 25% of sales. So we're going to do it both ways. Now, if we do it as 25% of sales, we work through our goods available for sale is going to be $818,000. Our sales at the selling price is $1 million minus the returns of $70,000 gives us net sales of $930,000 less the gross profit. So 25% of the 930. Remember, this is percent of sales. 25% is the gross profit as a percent of sales. Well, 25% of $930,000 is $232,500. Therefore, our costs are $697,500. So our approximate inventory at the end of the period at cost is $120,500. That is our calculation. Okay, that's if we did 25% of sales. Now, if we did 25% of cost, we need to do a quick little conversion here and figure it out. What is that as a percentage of sales? Well, a 25% of cost, that's the markup, is only a 20% of sales. So we go through the exact same thing, except our $930,000 is multiplied by 20% instead of 25%, which gives us a gross profit of $186,000 or cost of goods sold of $744,000, which gives us approximate inventory of $74,000 at the end of the period. So, quick reminders, this is just an estimate. This is only used for, say, internal purposes when you don't want to have to recount all of your inventory to come up with a ending inventory or cost of goods sold method, or when it's not possible. For instance, your warehouse got burned down, or you need to do, say, an insurance claim or insurance adjustment. So that is the only time this is used. It's not normally accepted for your financial statements in terms of being reported to the investors and to the public. Now, similar to our gross profit percentage, there is a retail inventory method. I am not going to go into great details about the retail inventory method. It is largely the gross profit method, but it's looking at retail markups and markdowns. You need to be aware that it's out there. It is a method used by retailers to value inventory without a physical count by converting retail prices to costs. Very similar, at least conceptually, to our gross profit method. The retail method just does it as a retail price to cost. So you look at like, okay, well, what is our typical markup on costs to get to retail? And then you use that to estimate your ending inventory value. So all this requires, and the benefit of this is for retailers, all they need to do is have total cost and retail value of goods purchased. Well, cost is easy because they purchased it, so cash went out the door. The cost is easy. The retail value, they also track. They know how much the retail value is of their inventory because that's what it's currently being sold for. They don't have to know what they bought it for to do this. So the total cost and retail value of the goods available for sale, that again should be pretty straightforward. And then the sales for the period, retail dollar sales. That's the benefit. They don't have to know the costs that go out, just the retail sales, just like in the gross profit method we just talked about. All you need to know is the sales amount and your markup percentage. So the retail inventory method is very similar, but it's looking at retail markups instead of just a generic gross profit percentage. Okay, reporting and analyzing inventory, the last thing we're going to cover. So for the presentation of inventory, accounting standards require disclosure of what's in inventory. So the composition of inventory, say work in process, raw materials, finished goods, etc. If there's any financing arrangements and what inventory costing methods applies, LIFO, FIFO, weighted average costing. That's a lot of times you'll find companies that use different methods for different types of inventory. For instance, when we looked at, say, the Mumford & Sons, which was the ranch in Wyoming, or I think it's Mumford of Wyoming. When we looked at that ranch, they actually had different inventory methods for each category of their inventory. That's not uncommon. So that has to get disclosed. And you have to have consistent application of the costing method across time. Now, it doesn't have to be across categories, but from one year to the next, you need to be using the exact same inventory method. You can't switch between LIFO and FIFO and weighted average costing from one period to the next. Again, because that would make the financial statements not comparable. Matter of fact, changing your inventory method actually is a change in accounting standards or principles that you're following and would need retrospective adjustment, as we talked about in previous chapters. So, inventory composition also has to be disclosed either in the balance sheet or in a separate schedule of the notes. It's usually in the notes. The balance sheet usually just lists one line item as inventory. So we also need to disclose significant or unusual financing arrangements, inventories pledged as collateral for a loan, for instance, or if you have, say, what are your financing arrangements for your inventory? Is it a normal 210 net 30? Do you have extended financing terms where you don't have to pay until the inventory is sold? That all needs to be disclosed. Okay, quick example. I just pulled Walmart. This is in their notes to financial statements. This is essentially note 1. How do they account for inventory? So Walmart company values inventories at the lower of cost or market. Good to know. Using a last in, first out for a lot of their inventory. So determines primarily retail method of accounting using the last in, first out method for Walmart US segments. Now, international uses FIFO. Sam's Club uses LIFO, but weighted average cost LIFO method, which is like super combination of things. So there's all kinds of combinations of different methods of inventory, but especially when you get into the LIFO world. So, but all I want to show here is this is how Walmart's disclosing the costing method for each type of its inventory. And lastly, if we'll notice, remember from our last week when we talked about the LIFO reserve, well, Walmart does not have one. As it states in the bottom, the company's inventories valued at LIFO approximate those inventories as if they were valued at FIFO. There is no LIFO reserve that they need to report separately. Analysis of inventory, the most common, just like we had for accounts receivable, the most common is inventory turnover and days inventory on hand. This is kind of like the sister or the brother of accounts receivable turnover and days collection, days collection. For AR, this is the inventory version. So the difference here is that inventory matches up with cost of goods sold, whereas AR matches up with revenues. So our inventory turnover is going to be cost of goods sold over our average inventory. So in this example here, our inventory turned over 7.53 times during the year. Now, if you wanted to figure out, well, what does that equate to in terms of days? Well, we just take 365 days divided by 7.53. That means our inventory is turning over every 45.5 days. Depending on your company, that may be good, that may be bad. A lot of times you want to be middle or better than your industry peers. One of the ways Walmart has been so successful is its days inventory on hand is very, very low. They do a phenomenal job of managing their inventory. They have essentially been revolutionary in the inventory management space for the last 50 years. And frankly, until Amazon came around within the last decade or so, Walmart was essentially undisputed champion. Now, Amazon has drastically changed that. I wouldn't quite say that's put Walmart behind, but it's definitely given them some more direct competition, which they have not had for probably most of their life. Anyway, that wraps up our inventory discussion. We dealt with costing last week. This week, we're dealing mostly with what I call valuation, or how do we value inventories in general. So lower of cost or realizable value is predominantly used. LIFO and retailers can use lower of cost or market. There's other methods when we actually have inventory that gets split up. For instance, our relative sales value or the market value if there's essentially a controlled market. Then how do we do for purchase commitments? What's our gross profit margin in the retail inventory method? How do we report inventories? And then how do we calculate inventory turnover ratio? So that wraps us up for inventory. With that, have a great day, everybody, and God bless.